Hello everyone, welcome. Just to let you know, this webinar is being recorded. It's lovely to have you all here to join us on this IFF webinar today. My name is Taya. I work alongside John Richardson, and we're going to focus on the rising opportunities of private debt. John's our subject matter expert, and he's going to give us an insight on the hot pressing topics in this fast moving area with a particular focus on investment opportunities. Just to let you know, it will last about 30 minutes. And at the end, we're going to have the opportunity for a Q&A session with John. So if you would, during the webinar or at the end of the webinar, post any questions in the little Q&A tab at the bottom of your screens, that would be great. I'll pass you over to John now. Maybe it would, if you could start with a bit of background about yourself, John, and then some background about private debt and how the market's developing, that'd be great.
Okay, thanks, Taya, and welcome everyone this morning. As Taya said, my name is John Richardson. I won't bore you with too much about my background, but very briefly, I'm the managing director of a corporate finance advisory firm in the UK. I used to work in investment banking, and we deal with credit funds, we deal with private equity, venture capital, so lots of investors in the market that are looking at opportunities across Europe, the Middle East, Sub-Saharan Africa and Asia, a little bit in Latin America as well, but not a huge amount in that area. So I get to see quite a lot of deals in the marketplace. I get to see quite a lot of activity, and hopefully I can help you understand a bit more about where this private credit market is moving. In addition to that, I'm also senior visiting lecturer at Bayes Business School in London, been involved with them for many years. So I get to see the academic side as well a little in terms of some of the new things perhaps that people are thinking of in that particular area. In terms of the actual private credit market itself, I mean, what do we mean by private credit? We mean non-financial institutions that are lending mainly to mid-market corporates, so to private institutions. They are set up usually as closed-end investment funds, often tax-efficient structures, particularly some of the American funds. And they're fairly illiquid assets, of course, that you're dealing with. The benefit often for the investors in those particular assets, of course, is you've often got lower maturity risk in terms of duration of those particular assets, and you sit higher in the capital structure. So if you're thinking about it from the point of view of risk, you know, it's not like investing in private equity when you're at the bottom of the capital structure. You know, you've got a bit more protection in terms of the actual investments that take place. We'll talk more about that in terms of who's investing in this, you know, and what the particular objectives might be as we go through the session. But the growth in this marketplace, it really began in the European market after the financial crisis. So if you go back to 2008, 2009, and we think about what was happening there, obviously there was great concern about the banking sector in terms of the risk of the banking sector after the Lehman collapse. And there was stricter regulation came in on lending, particularly to this particular area of mid-market corporates, and greater restrictions in terms of the actual capital that was required to support that lending. So more tier one equity capital is required by the regulators for banks. It made it economically more difficult from an operational cost point of view to actually invest in those particular areas from a banking perspective. So most of the banks deleveraged out of that marketplace. They couldn't see the attraction of lending into that market. At the same time, of course, we saw an environment where we had extremely low interest rates, lots of QE obviously coming into the market, lots of money available in terms of opportunities to invest, but not many investment opportunities in the more traditional asset areas. So from the investor perspective, and we're thinking mainly here about pension funds, either public pension funds or private pension funds, because they are the main investors in the marketplace, of course, globally, and they're quite heavy in terms of investment in this particular area in private credit as well. They were looking for yield opportunities. They couldn't get their yield out of their more traditional investment strategies. They were looking for other opportunities. And therefore, this created the opportunity for these credit funds to be set up as investment funds. They are not regulated like a bank. They are an investment fund, so they still have some regulation, of course, in terms of the investment fund regulation, but they didn't have the capital constraints that a bank would have. And so they could offer this product into the marketplace in terms of debt product, and it really actually expanded beyond that, where there are now a range of opportunities that you can invest in terms of credit funds. And it's really that change in the marketplace that is one of the things I want to emphasize to you during this webinar in terms of where this is developing. And then thinking about, well, what's the future going to hold in an environment whereby clearly at the moment we have recessionary conditions, depending on where you are in the world, it's more or less serious in terms of what's happening. And we're not quite sure what's going to happen for the rest of this year. And therefore, it's thinking about that particular development. So that's really the focus of this from the point of view of the webinar, is to think of the way forward in terms of this particular market and just explain what these particular funds actually do. As Taya said, we'll be answering some questions at the end, so please do put your questions in the Q&A, and I'll try and answer as many as possible as we actually have time. But we will answer all of your questions before the overall conclusion of this. So we'll try and send you emails and make sure that we try to address all of those issues for you later. And you will get a copy of all the slides as well. So all of that material will be made available for you. Let's have a look then at the issues that we want to cover. So I'll put some slides up, and these are the slides that you're going to all get a copy of. I think, first of all, in terms of the broader market here, why do people want to use private debt? What are some of the advantages in terms of looking at this in the marketplace? Well, I guess when we start to look at it in terms of the context, the public markets, and we're talking here about syndicated debt, so the market where we're talking about larger volumes of debt going into capital structures, to all extent and purposes, that's been closed for quite some time because of the risks that are inherent in the market. So when you're looking to raise capital for opportunities, and often these are sponsors such as private equity sponsors looking to raise capital, often the syndicated market is pretty difficult. It takes a long time and sometimes just not available at all. So in terms of availability of funding, here's an opportunity where clearly these credit funds can actually fill that gap. It certainly helps getting deals done. There's a lot of money out there at the moment looking for a home. The private equity funds have got lots of capital available to utilize, to draw down, what they call the actual capital that they can utilize, the dry powder that's actually there. If they don't utilize it, they're not going to make money in terms of their opportunities. So this also gives them an opportunity to utilize that funding. And obviously that's an important source from growth point of view and investment point of view in a whole variety of different areas. So it opens up that opportunity in terms of investors being able to participate in that in a different area in terms of risk. So rather than investing in private equity, where you're actually taking that equity risk, you're at the bottom of the capital structure, you're investing higher up the capital structure, different risk in terms of the overall risk return dimension that you're investing in. And of course, overall, we're actually looking here at also a product where the ability to execute that more efficiently than banks might operate is one of the key drivers. In private credit, they can often make the decisions much faster, and they are actually much more nimble because they're smaller institutions. Often the banks are quite slow in terms of decision making, and that gives a real advantage in terms of private credit in the market. So quite a number of reasons why people are looking at this particular marketplace as an attractive area, either from the sponsor point of view in terms of availability of funding, or from the investor point of view in terms of the opportunities this gives for investments. If we think about it from a broad strategic point of view, it's always about risk and reward, isn't it, when we think about anything in terms of finance? And so we're trying to balance up the risks we might be taking for investing in this area against the potential gains that we can make in terms of returns on that particular strategy. And I would categorize it in three main areas here. You've got what they call capital preservation strategies, which is mainly senior debt. And that is the core of the product that the private credit market will offer. So it's senior lending, direct lending. It's going to be usually fully secured. There's going to be good documentation supporting that, so covenant documentation. And that's one of the other areas clearly that is an advantage, because in the syndicated market, there's been a big move towards covenant light structures where there's very little documentation to support that lending. That's not the case when we're talking about private credit. They'll be looking much more in terms of the more traditional covenants that we would put in documentation. So that the senior debt product is really the core product that's being offered here. In addition to that, on various transactions, we'll put mezzanine debt or subordinated lending in in addition to the senior debt. And it may be put in as one product, a unitranche type product, whereby we put that as a combination. So the borrower actually borrows a senior debt facility, but what we're really lending is a mix of senior and junior debt in one particular product, that is unitranche. And the advantage of that is we can offer, as a lender, to go to a higher structure in terms of EBITDA multiples, so typically up to 5 times in terms of debt to EBITDA. Whereas if you were doing that through a more traditional funding structure, you'd have to talk to lots of different lenders to be able to structure that. And that increases the cost, it increases the time as well. So from a private credit point of view, they can do it more efficiently. Then if you look at return maximization strategies, you're thinking more there in terms of more structured credit products. So some of the credit products where you're thinking perhaps of preferred securities, or you're thinking of payment in kind type structures, whereby you're getting into more complex structures where you would expect a higher return, but clearly it is more risky. Or you might be looking at distressed debt. And there are quite a number of funds that specialize in terms of distressed debt. Hasn't really been a big growth area in recent years, but clearly is likely to have more emphasis as we move forwards. And quite a bit of money has been raised in that marketplace to address that issue. And then, of course, the more opportunistic and what you might call niche strategies that people will follow, where maybe they're looking at companies that are going through a refinancing situation and they're looking for opportunities in terms of how they can refinance more effectively. Or maybe it's more focused in terms of a special area. So asset-backed lending, so moving through looking at receivables type lending or broader asset-backed lending, or maybe lending on net asset value in terms of lending. So you're lending to private equity on the asset base they have, NAV lending, or maybe non-performing loan strategies. They tend to be more niche. There isn't as much money that is actually put into those areas. But the great benefit of having a range of strategies, of course, is that you can offer a one-stop shop to the investor. So the LPs, the investors who are looking to invest their money in these fund structures, which, as I mentioned earlier, are broadly going to be based on the pension funds that are looking at that, because that's where most of the money is coming from. But you're also looking at sovereign wealth funds, you're looking at family offices, you're looking at high net worth individuals. There are a whole variety of different investors who will be looking at this from a strategic point of view. What they're now looking for is actually that one-stop shop. So having done the due diligence on the credit fund and having been comfortable with the people involved, the strategy, obviously the track record that they've got, they also then want to look at, well, what can you offer us in terms of a range of opportunities? Are you just offering us a senior debt type structure, or can you offer other things? So can you diversify in terms of those particular assets that we can invest in? And then what they will offer, of course, is a separately managed account for particular investors in those areas. So that's really where that market is sort of starting to develop into a more broader range of strategies. No longer is it appropriate just to have one strategy in terms of what you're doing. And each of these strategies obviously will deliver you specific return targets, not necessarily achieving them, but those will be the targets that you're looking at. And you can therefore have a range of risk and return strategies whereby you've got a portfolio risk there. So for clients, they can allocate a certain amount of funding to the credit fund, which can then be spread between different strategies. Gives more opportunities, and that's, of course, what LPs are looking for in the market. So first poll question for you here. We've got a couple of polls just to get your view on this as we actually go through. But what do you think is going to happen to assets under management in private debt this year? Do you think it's going to be fairly flat? Do you think there'll be no growth in direct lending, but perhaps distressed lending, is going to grow? Do you think it's going to decline? Obviously, there are issues in terms of loan defaults coming forward. Do you think we'll grow at the historic growth rate, which has been, reasonably rapid over the last few years? Or do you think actually it's going to grow at a faster rate than last year? So give us your views on this. We're interested to know what you think about this. I have a particular view on this, but I'm certainly interested in terms of what the general view is in terms of this particular marketplace. So I'll just give you a few seconds to put some votes in on this. And when we have sufficient votes, we will make the results of that clear on the screen so that everyone can see. it's an interesting marketplace in terms of private debt and in terms of the way it's operating. And a few years ago, very few people knew about this marketplace. I think it's becoming more talked about now in the market, and more investors certainly looking at this, but generally more sponsors are seeing the attractions of this particular marketplace. So where are we getting to in terms of the voting on this? Shall we see what we've actually got in terms of this? So we seem to have quite a number of people that have already voted. So why don't we show the results of that poll now? So if you can put the results up on the screen. What have we got here? So looks like quite a few people think that we're going to grow at a faster rate than 22. So 34% of you actually think it's going to be quite positive this year, or it will grow at the rate of last year. And quite a number of people there thinking, well, it's going to be quite a growth in terms of the distress market. Interesting in terms of the promise perhaps that you see in this marketplace in terms of what you're actually getting there in terms of this. Just one question that's popped up on the chat, which I'll answer straight away. So someone has said here, is private credit the same as private debt? Yes, in terms of that, when we talk about private credit and private debt, really the same words in terms of that, same connotation in terms of what we mean here. We're really talking about the private debt market. In other words, we're not lending here to quoted companies, we are lending to private mid-market corporates. And each of these particular funds that are set up will have different strategies in terms of scale, in terms of how small or how large they'll actually look at. So some of the larger American players, they go to quite large transactions now. You know, you're talking 1 billion plus in terms of the sort of funds that they'll be looking at investing in various sponsor-led deals. Some of the other funds, you know, much smaller than that in terms that we look at. But we're always looking at private transactions. We're not looking at public transactions. So there's a significant difference, in other words, between the syndicated credit market and actually looking at the broader market in terms of what we actually see in terms of the credit market. Clark actually asks here, what do you think is the impact of much lower valuations of many companies that have private debt in terms of what's actually there? I think valuation is always a tricky one in terms of looking at this, because there's a big difference between price and value in terms of what you actually see in the marketplace. Clearly, we'll talk about that in a moment in terms of capital structure, but the basic capital structures that you see, particularly from a sponsor point of view, have really moved more towards a 50-50 capital structure. So half debt, half equity in terms of a sort of a target capital structure. The difficulty with that is that as valuations went up in the marketplace and people were paying 11, 12 times EBITDA, 50% debt in the structure was still 5 or 6 times in terms of debt to EBITDA, which is, you know, reasonably heavily leveraged in terms of a capital structure. As valuations come down, the debt stays there, but of course the equity comes down. And so suddenly you will find actually the debt to EBITDA multiples going up. And that's a real risk in terms of what we see in the marketplace. We'll talk about that in a moment in terms of the potential problems that we might see coming in the market. But that's a really good question, because I certainly seeing that in terms of some of the structures. Clearly, you're seeing the debt to EBITDA multiples increasing because of the historic debt that is there. If we think about this from the point of view of how some people view this market, this is Preqin data, which is quite useful. You know, they're reviewing all of this from a whole variety of different credit funds perspective and different investors' perspective. So they get a reasonably good overall view of the market. And their view on this is it's going to slow a little bit in terms of the growth rate. So if you look at the compound growth rate since 2010, you know, it's 12, 13%. In terms of growth, it'll slow in the next 5 years, probably to about 8, maybe 10% in terms of compound growth going forward. You know, some people think it might grow a little bit faster. I think the interesting point in that is that pretty much everyone in the market has got their strategy based upon raising more funds going forward. So all the credit funds that I deal with in the market, all of their strategic plans for the next 5 years are to increase in line with what Preqin is saying. Pretty obvious, because this is where Preqin is getting the data from. But they're all actually pretty optimistic in terms of their ability to raise more assets under management. Now, there's a real question there about, is the market big enough for that in terms of that growth? You know, have we actually got enough capacity to use up that particular capital? and what risk does that bring with it? Because in any credit market, when you see that sort of growth taking place, normally you see some credit risks actually emerging from that, and you see problems coming. And we haven't seen that yet in the private debt market, but if we continue with that growth, perhaps that is one of the issues that we need to be concerned about. And when we look at that from a default point of view, you can split the market here into the broader market in terms of more the syndicated debt market, which is this bit of data from Moody's. This is a later forecast that Moody's had done. So one of the ones they actually did quite recently. It's only up to December last year, but they actually only published this a couple of weeks ago in terms of their default forecasts. And you can see that on a global basis, if we're looking at the speculative grade debt market, so you're looking here more at syndicated debt, the larger transactions, and often in public as well as private markets in terms of what they're looking at here. You can see they're pretty pessimistic in terms of their forecasts in terms of what might happen. The average is that it's going to increase somewhere between 4–4.5% in terms of defaults, depending on whether you're in Europe or the US. But the pessimistic view of that is it's in excess of 10% in terms of those markets if things go actually in the wrong way. So clearly everyone is a little nervous about this from the point of view of the potential for more defaults to come through in the broader market. And this is one of the reasons the syndicated market has pretty much closed at the moment. If you're trying to raise money in terms of syndicated debt, very hard to actually do that at the moment. You'll still find transactions where people will finance it, of course. But it's difficult to do that. However, if we look at that more from the private credit market, more what the credit funds are doing in the marketplace, more mid-market deals, smaller transactions, typically, although as I said, they will often go to some larger deals, you can see that actually the default rates are much, much lower. So if we look at the trend on that over the last few quarters, then depending upon what size of company you're talking about here, because these are EBITDA sizes in terms of the different colors, you've actually got a much better result here in terms of defaults coming through. Now, people would suggest to you that is because underwriting standards are better. It's because execution risk is better, deal selection is better. They're more focused in terms of what they're doing, and certainly I see that in the funds that I deal with. They're clearly in a competitive market. They're always looking to compete on origination, but they're also quite selective in terms of which deals they will finance, and therefore they're able, because they're often looking at it from the perspective of raising more funds in the market and having to have good history in terms of what they're doing in terms of defaults. They're actually much better at their deal selection and their deal management on that, rather than the syndicated market where not so tight usually when we actually look at those in terms of what actually happens. Now, will that continue in the future? I mean, that's the real question, isn't it? Because we're seeing that default rate, as you can see, in Q4 last year starting to rise, and I would expect it probably to continue in terms of some increase, but it's still significantly less than what we see in the syndicated debt market. So I think there are really some benefits in this from the point of view of the way in which they're structuring their transactions. One of the issues clearly could be that in the syndicated market, an awful lot of the debt was raised on the basis of covenant-light deals, very little covenant protection, whereas in the private credit market, there's much stronger documentation and covenant protection in terms of transactions. And that clearly is a benefit. When you're looking at deals that are struggling, you've got strong protection in there in terms of asset protection and covenant protection, you're more likely to get good recovery rates and obviously less problems in terms of structuring those particular transactions. So that could be a reflection of that coming through. And certainly the credit funds are much better, I think, at actually doing that. In terms of the return for the risk, we're looking at the defaults from the point of view of the sort of risk that you're taking in terms of investing in those particular businesses. Well, look at the return that you're getting. It's pretty good balance in terms of what you're getting. This is the 1 year time horizon internal rate of return on average on private debt. And I would stress this is average. Obviously, you get a variety of these as you actually look across the market. But mid last year, in terms of the latest data coming from Preqin, you've got about 9.5% in terms of an internal rate of return on the strategies that private debt is following. And it covers obviously a range of strategies. It's not just the senior debt strategies. It will include the others, which are higher return, higher risk strategies as well. You can see over time there is clearly some volatility in that, as you might expect. But on average, if you are an LP looking to invest, or a pension fund looking to invest in this is a pretty attractive asset class because of that. Because you've got actually an acceptable return for the risk that you're taking. You are in a good position in the capital structure. It diversifies your investment opportunities. It is another opportunity, clearly, from an investment perspective. And that's really where they're targeting this in terms of how they can actually raise funding. Fundraising has slowed. It's taking a little longer to raise funding, and fundraising is becoming more concentrated in a limited number of funds. So people are actually being a little bit more selective now in terms of which funds they're going to commit capital to as they go forward. As you might expect in a more stressed market, you tend to see that happening anyway. And we're seeing that particular trend come through as well. But I think it's the key differences here that we see between the private credit fund and private debt and syndicated debt that actually show quite starkly, why we might be interested in terms of private debt. Because when you look at syndicated debt, there are a large number of participants. Private debt, very small number. It might only be one private debt fund structuring that transaction, or it will be a very small number that are combining together. Deal size tends to be a bit smaller because we are looking at the mid-market. We're not looking at the large transactions in the marketplace whereby syndicated debt would look at that. Pricing is a bit more expensive. And the reason it's a little bit more expensive is because often they're doing a combination product. They're doing senior and junior debt together in one product, a unitranche deal. And clearly that is going to be a little more expensive. But the benefit you get is you've only got one set of documentation. You're only dealing with one credit fund often to structure that. So there's only a discussion with one credit committee. It's quicker in terms of execution. And, you often have more certainty over the deal structure you've got. When you're dealing in the syndicated market, there'll always be flex in the transaction in terms of structure and pricing. When you're dealing with private debt, you don't get that. What you see is what you get, basically, in terms of the documentation that is being offered in the term sheet. So bit more certainty, and it's quicker, often much faster to execute. They're more nimble, basically, than actually the broader marketplace in terms of syndicated debt. Obviously not rated. Very rarely do you see rated debt in the private debt market. It's usually non-rated transactions. That does pose some issues because when you're trying to understand the risk of the portfolio, you are relying on their internal assessment of risk in terms of how that particular fund is operating in risk and return. Whereas when you're dealing in the syndicated market, you have credit ratings where obviously you can assess the risk of that. However, you'll all be aware of the problems of using credit ratings. I mean, that's not guaranteed to give you actually an indication of what the risk really is. And we've seen many examples of that, of course, over recent years. So although some people would say that's a problem, I'm not sure it is. I think the private debt funds actually manage that pretty well in terms of that rating risk. Sort of opportunities looking at this in the future, I think it's about dry powder and what's there. If you look at the little chart here, you can see big increase in terms of available funds from private equity perspective that they can draw down, the capital that's being committed and not yet drawn. And you've got a similar issue in terms of the dry powder for the private debt market, but not the scale of that. So you've got all this available funding that needs to be committed because otherwise the funds don't make money, because the private credit funds operate in a very similar way to private equity. They will charge a management fee. Often they'll charge some other fees within the structure as well. And then they'll have carried interest based upon a performance target. Very similar to the way in which private equity operates. The numbers are a little different, but the principle is the same. So if they don't commit the capital, if they don't use it, then clearly they don't make money out of that. You've got high levels of volatility in terms of the markets, in public markets at the moment, concerns actually about where those markets are going in terms of public markets, tends to be more focused, therefore, on private markets. Obviously, lack of activity in the syndicated market means people are looking for credit solutions. So, if you are a private equity sponsor looking at doing a large transaction, then you really can't utilize the syndicated market at the moment. You'll be looking at private credit and the money is available. And of course, although you've got activity levels slowing down generally in M&A activity, and certainly in the last quarter, we've seen a slowdown, PE sponsors still have a lot of money to invest. They still will need to push in the marketplace. They need to deploy capital. And if you look at the relationship there in dry powder between private equity and private debt, you can see there's a big incentive for sponsors to actually invest that capital. And therefore, there's a big opportunity for private debt to be a bit more selective about which deals they want to actually invest in. Because the emphasis is going to be that private equity sponsors are going to be the ones searching for the opportunities for raising funding. And therefore, private debt sponsors can perhaps be a little bit more selective in how they actually deploy that capital, but they still need to be deploying capital in that. So it sort of leads us to what are the challenges for private debt this year? What do you think the difficulties might be? Another little poll question for you. You could think of a variety of things. I've just put down 5 here. Is it going to be about this issue of disciplined deployment of capital? Is it going to be operational challenges? Can we find the people to do what we want to do? That's a real problem at the moment. Is the recession going to be worse than suggested? No one really knows where we're heading with that. And what about competition? In the marketplace, the US market is pretty saturated at the moment with private credit. And what they're doing is geographical expansion into the European markets and other marketplaces as well. And therefore, there's quite a lot of competition coming from the very large private debt funds like Ares and others who are coming over and competing heavily in the European markets. Or is there going to be maybe some black swan event that we haven't really thought about? Excuse me. So what do you think might be the problem here going forwards? It could, of course, be several of these in terms of the actual difficulties that perhaps are faced with this. But where do you think the focus is in terms of potential difficulties? And again, I'll just give you a few seconds to think about that in terms of where you think the problems might actually lie. Okay, let's see the answers. What have you got? So disciplined deployment, yeah, or recession. I'd agree with you. I think one of the major problems that we face in the marketplace at the moment, and certainly with the funds that I deal with, is how do we manage this from a deployment point of view, given the fact that LPs have committed capital to us, we need to deploy that capital. We're faced actually with opportunities in the market that sometimes are a little limited in terms of what we would like, because there's a lot of competition around. How do we make sure that we don't actually take too much risk? And I think that's one of the difficulties. Now, that really is about the people involved in the fund structure in terms of how disciplined are they going to be when faced with that sort of problem. I think that's a problem strategically that they face, and some clearly are going to be better than others in terms of how they manage that. The risk of a deeper recession, yeah, that's always going to be a problem for everyone, I guess. I mean, and that's a problem generally in the marketplace. We're not sure what's going to happen with that. But actually, the mid-market has been pretty resilient in terms of how it's managing that. I'm not sure I'd be so concerned about that going forwards. From my experience of dealing with the funds, one of the problems actually I would be more concerned about is some of the operational challenges. As we grow, can we find the right people to actually fill the roles that we want, particularly in areas like origination? Have we got the right people who have that experience in origination? That goes back to disciplined deployment. And then in the credit function, because they're quite lean and mean, these organizations, in the way in which they operate. They're not like financial institutions, which often have far too many people often in some certain roles. They don't in these credit funds. They're pretty lean and mean in the way in which they operate. And that means you are relying heavily on a small number of people who are experienced enough to do that job. And as you grow the fund, how can you find the right experienced people? That becomes much harder as you start to progress. So there's an operational challenge, I think, with that. You could argue for all of these clearly that there are going to be problems in all of those areas. I don't think it's as clear cut as that in terms of what we see. But I think obviously disciplined deployment of capital, I'd agree with you. I think that's going to be a problem going forward, which means as an investor in that, picking the right fund to invest in and understanding the strategies becomes really critical when we actually look at how those particular funds are operating. So how are LPs responding to this? What are they doing? Well, increasingly being concentrated in a smaller number of managers. We're seeing that in terms of fundraising. It's easier for some of the managers to raise funding than others. You know, it's the track record, it's the team, it's the strategies, and definitely there's more of a concentration in that. So a bit more selection in terms of what we do. The overall investors in the market, mainly pension funds, but obviously you've got endowment funds, insurance companies, family offices, you know, they're actually quite willing to accept some of the illiquidity risk because obviously the assets are not liquid. You know, you are locked into this in terms of the actual asset investment until you get repayment or refinancing of that debt if it's a senior debt structure. But in a more volatile economy, they'll probably show a bit more interest rather than less because you're higher up in the capital structure. So rather than investing in private equity or other strategies, you know, this might give you a bit more protection actually in terms of that risk. And you've got to invest somewhere, you know, so you have to invest something in terms of the funds that you're holding. Pension funds, they're the big players in this. On average, they hold about 3% in terms of allocation of funds into private credit. Some are much higher. You know, you see some where they're up to as much as 20%, which is a pretty high concentration risk if you think of that. Insurers expected also to play more heavily in this marketplace as we go through the rest of this year. And then, of course, you've got all this issue in terms of high net worth investors, high net worth individuals in the market, and also maybe moving into retail. And quite a number of the credit funds are looking, how can we actually structure transactions to look at a different source of funding for what we're actually doing? So, you know, the pension funds, the other investors in the market, they're your traditional funding, and they're always going to be the anchor ones that we actually look at in terms of investors. But we're always looking for other opportunities. And at the moment, a lot of the funds are looking, how can we structure this where we can offer it to a retail type investor? And it'll have to be through, you know, a different type of fund structure. And you're starting to look also with most of these major investors in terms of separately managed accounts, SMAs, where they'll run an account specifically for an investor and give them that diversification opportunity then as well. There are also obviously opportunities for niche strategies where people are looking to pick off, you know, where can they see opportunities for competition in the market. And a number of them are looking now at moving into offering things like revolving credit facilities. Obviously, distressed debt and other things people have already done, but they might look to expand into that. But traditionally, revolving credit facilities would be more of a syndicated debt market, whereas the credit funds now looking, how can we provide those facilities as well? So seeing quite a lot of changes in the market in terms of the way in which competition is actually evolving in this marketplace. You know, people looking for more strategies, more product strategies, more geographical strategies. So, you know, moving away from just the core European market, because the main market is the UK, France, and Germany in Europe. That's where most of the deals get done. But they're actually looking now to change that into a broader European market, and also then to move into Middle Eastern markets, to move into African markets, to move into Asian markets. They've all got strategies for geographical expansion as well as product expansion, you know, and this market will continue to grow in those particular areas. And I run a course, you know, just a shameless plug for a course that I run in terms of private debt. There's a masterclass here that actually we run through Informa, whereby we go through these in a lot more detail in terms of a face-to-face class, where we can get into this in terms of some of the detail of how do they actually operate internally and what are the broad strategies that we can think of in a bit more detail. So any of you are interested, you know, there's a lot more that we can talk about. This is just really an introduction to what are these particular issues in private debt that perhaps you should think of. If you want to know more, you know, very welcome to come along and actually spend time actually going through this in terms of this particular masterclass, where we can talk about this in a lot more detail then in terms of what we see there. And it leads us to some questions in terms of, you know, what are the sort of core questions that you have? I answered a couple, obviously, as we were going through there, but it'd be interesting to have a look at what other questions have you posed in the Q&A here. How is it priced here in terms of private credit pricing, in terms of margins terms? How is it impacted by the public market in terms of high yield and leverage loans? different marketplace in terms of what you've got there in terms of the risk return dimension, because often we're looking at a different balance in terms of risk and return. So, you know, there's sort of standard pricing if you look at it from a unitranche point of view, where often they're talking about 650, 700 basis points over a benchmark, you know, over SONIA or historically over LIBOR in terms of what you might see there. But obviously it will be risk priced in the same way. It's going to be a bit heavier pricing, as I said earlier, than you would see in the syndicated or the broad market, because it's often actually more tailored to the situation. Often it's a little bit more leverage as well that they might put in terms of a structured product within that. So it costs you a little bit more in terms of the margin that you actually pay. And often there is a management fee and other things, the same as private equity would operate in that. It's whether you see the benefits from actually getting a faster structure in terms of the funding structure and not having to deal with a multitude of different lenders, often only dealing with one credit fund. And that can be a great advantage in getting a deal done, of course. Cost of funds rising for traditional banks, forcing borrowers to seek private credit. Is it ready for the increased need for due diligence? There's always an issue here, and this, I suppose, was the question about, you know, whether we see greater problems occurring as we actually go forward in the future in terms of the growth of the market and maybe more risks actually coming out in the marketplace. Clearly, there's always going to be that issue of, you know, are you getting pushed too heavily from having to deploy capital and deploy funds? Do you take too much risk in the marketplace when you actually do that? I'm not seeing that happening, but clearly that is a risk that could happen in the marketplace. Do you believe private debt will be taking market share from banks, high-yield bonds, syndicates? They're already doing that. So in the marketplace, the main sort of go-to at the moment for private equity is credit funds. It's not the core banking sector. So banks have pretty much gone fishing at the moment in terms of that mid-market. Clearly, they're still lending in some areas, but the core sort of lending now, if you're looking at doing a sponsor-led transaction, is going to be the private credit funds, definitely. You know, that's been happening over the last 2 to 3 years, where there's been a big emphasis and a big push in that area. One of the things that we're actually seeing with that, of course, is what's called bifurcated lending, where the banks and the credit funds are actually working together. So it's the banks, clearly you're worried about this, because from a relationship banking point of view, you lose the relationship with your client if the credit fund takes that particular facility. And so what's often happening is that the banks will act as introducers of deals to the credit funds, and they'll then work with the credit fund to structure the lending facility. So they may lend 1 times EBITDA as a senior structure, and then the credit fund comes behind them and then lends maybe 3 or 4 times EBITDA in conjunction with the bank. The bank would be in a senior position to the credit fund in that structure. They call it bifurcated lending, by, you know, 2 lenders involved in the same structure. You could clearly get more than 2. That's an advantage for both counterparties. From the credit fund point of view, it improves their origination. From the bank point of view, it keeps the relationship with the client. And so, you know, there's a trend in that market. I think lots of these things will be developing as we actually go forward in terms of what's happening. Francis says here, how do you see the private debt market looking in Nigeria? Pretty small in terms of that at the moment. It's one of the issues that you actually see in terms of geographical expansion, where they're looking at the African market and they're looking at what opportunities exist, but pretty small. I think you will see more and more development in these markets as the market expands more and more, because as the European market becomes more saturated, particularly with the Americans coming in, you see more geographical expansion and more opportunities. It's never going to be a huge marketplace, I don't think, in that area, but there are opportunities geographically, clearly, for people to look at that in terms of what we actually see in that market. How can private debt be an opportunity for non-financial professionals in terms of what we actually see? There is an opportunity there. You're thinking of that, I presume, in terms of, you know, how you work for those particular credit funds. There's still an opportunity in terms of how those credit funds work internally in terms of operational management, because there's still a need, obviously, to manage the business internally. And I think one of the things there that people are focused on quite a lot now, and particularly LPs, is ESG, you know, environment, social governance, and all the issues actually around, you know, gas emissions and about diversity, inclusion, everything that goes within this in terms of that sort of package. LPs are very interested in that. They want to see what the credit fund is doing internally and how they're managing that. But they also want to see when you commit the funds, how are you measuring the KPIs of the companies you're investing in? So how are you managing that? So there's a broader spectrum, I think, here. It's not all just about the finance bit. You know, there's an operational side to how you actually operate as well. Someone said here, you mentioned they're mostly closed end. Do you see any move towards open end funds actually coming in? There is a possibility of that. You know, the regulations are changing. So the Alternative Investment Fund Managers Directive is going to be revised in 2024. So next year, we'll see a change coming in that. And the discussion there is, could we actually operate some of these as open-ended funds rather than closed-end funds? So I would say, you know, keep looking at that. There's a possibility that we'll see some revolving fund structures there with open-ended funds rather than just closed-end. At the moment, they're almost all closed-end funds that we actually see. But definitely with the new regulations actually changing in terms of investment funds regulations. Remember, they're not managed in terms of bank regulations, it's investment funds. And this whole shadow banking area, of course, is one of the risk areas that people are nervous about, because you're not really sure around the market how much risk is there really sitting in credit funds. And so they're always looking at how can we actually start to assess that better. And at the moment, they haven't really answered that question from a regulatory perspective. But definitely, I would see a move probably to more open-ended funds coming in the future. Not at the moment, but probably happen next year or start up to that. Let's have a look. What else is there in terms of questions? Probably got a chance just for a couple more in terms of this. What will be the future for funds which have been unable to fundraise? Do you expect consolidation in private credit? Good question. I think there's a very good chance of that. I think that some of the smaller ones will have to be consolidated. They'll get bought out by some of the larger ones because it's just the way the market will operate. They'll find it very difficult, I think, to raise sufficient capital to really be economic in their operations. So yeah, I would expect to see more consolidation in terms of that happen as we go forward. And last question, and we must finish then because we'll be over time. Do you see a hindrance for hard currency debt funds in emerging markets in terms of local currency? Is the local currency market growing in emerging markets in terms of private equity? It's still small, I would say, in that marketplace, but it's another example of how all the funds are looking for diversification. What can we do in diversifying our product offering and our geographical offering so we can give LPs the broadest opportunity to spend time doing the due diligence on our funds? Because remember, before you commit to investing, you know, you're going to do a lot of due diligence before you actually decide to actually sign that mandate to commit funds to the private credit fund. It's going to take at least 12, 18 months, you know, to go through the total fundraising process. And once you've actually decided that this is the fund I'm going to commit to, then you want to see the opportunity to have diversity in that in terms of product and geographical diversity. So all of them are looking for that particular opportunity. It's just having the capability to manage that with a smaller team of people. And as I mentioned earlier, you know, that's one of the issues as they grow. You know, can we actually manage that risk as we go forward in terms of the variety of risks that we face? And as soon as you start to move more into emerging markets, you know, you're going into a whole series of other risk areas you've got to manage. If you've already got some experience of doing that, and you've got some track record of how you've managed that, clearly it's far easier to convince the LPs that you have the capability to do it. For someone who is just diversifying straight into that area without no experience, I think that's a hard one to convince LPs that you're not taking too much risk in that area. And therefore, you know, it's a difficult problem to solve, I think, in terms of there isn't an easy answer, I think, to your question there. I think there isn't enough time to answer all your questions. Thanks for all of those, because there are lots of really good questions. The ones that I haven't answered, we will be answering. We'll answer it actually through email, and we'll promise to get back to you on all of those. But in terms of my input on that, thank you for listening. I hope you've enjoyed it. I hope you found it informative and useful, and I'll hand back to Taya.
Thank you so much for your time, John, and your insight. That was really, really interesting. As John said, we'll try and get back to all of you very shortly on any unanswered questions. We do have the webinar now in full is concluded. We do have a little survey that would just take 2 minutes to complete. If you scan the QR code on your screen now, there's a little survey, so we'd really appreciate your feedback. And we will be running more of these webinars, and obviously John mentioned the course coming up. So if there is anything more you want to ask, or you're interested in further webinars or the course, please get in touch with us. That would be great. And thank you for joining us today and sharing your time with us. I hope you have a wonderful day. Thank you.